Everybody, estate planning attorney Paul Rabelais here. Got a lot to share. Getting the screen straight. Okay, a closer look at the federal estate tax return, IRS Form 706. Boy, there's so much here. But I like the idea of at least having a group, chat about this, putting a video online about the estate tax return because there's so much written and said about, hey, what's the estate tax exemption? What was it last year? What is it this year? What might it be next year? Is it going to be cut in half with the expiration of the Tax Cuts and Jobs Act? Is the exemption going to be 7? So what's included in the estate? So much talk about it, but you don't really see a lot on. Let's take an actual look at the form, and that should educate you a little bit more about how all of the estate tax reporting process works. So in a moment, I'm going to put an estate tax return, IRS Form 706. I'm going to put it up on the screen. And really, this is just an introduction to the IRS Form 706. There's so much to it, and I don't want to put you to sleep. I want to go kind of fast, but give you that good introduction to the return and what kind of information they ask for and how it gets reported. I see we've got some chat. Always, support the people in the chat, especially my friend Larry from California. Good to see you, Larry. But we've got some questions here. Let me jump to those. By the way, if you have any, questions, comments, experiences, and they're positive or constructive, feel free to put them in the chat, and we'll see if we can't recognize you and maybe address some of the things that you put in there. So we have one here that says it would be interesting to get your thoughts on 709s. Again, the focus on this one is about 706s. The 706 is the estate tax return. We'll talk about when that's required to be filed. What you're asking about here, R Wyatt maybe, is about the 709, which is related to the 706. Now, the question is, I would be interested to get your thoughts on 709. 709s feed into the 706s. That's one way to say it. I've completed several, but they are complicated. I may have made errors. Looks like you went into a second chat, probably ran out of characters. I know I haven't gone over my lifetime exemption, but may have entered gifts in the wrong boxes, audit problems. So who knows whether there be problems? It depends on whether that it gets audited and what kind of stuff you may have put in the wrong part on the 709. But yeah, the 709, it's very related to what we're going to talk about here on this live stream, the 706. When someone makes I call it taxable gift, has nothing to do with income taxes, has everything to do with the gift and estate tax. I like to use the example, let's say during his lifetime, dad made a gift to his daughter and he did it in 2024, made a gift of $118,000. Maybe he wanted to help her buy a home. Doesn't really matter what the gift was going to be used for. We have this $18,000 present interest annual exclusion for 2024. Back in 2023, it was $17,000. This year, it's $18,000. My dad making a gift of $118,000 to his daughter. First $18,000, IRS says that's okay. That falls within the annual exclusion amount. But Dad, you made a gift of $118,000 to your daughter. So what has to happen, or what's supposed to happen, is Dad has to report on that Form 709 that he made a taxable gift, a gift in excess of $18,000. He wasn't a tax, but Dad used $100,000 of his what is now $13.61 million estate tax exclusion amount. So now when Dad dies, if that was the only taxable gift that he made, he could only leave $13.51 million free of the 40% estate tax instead of $13.61 million. So when you make a taxable gift, a gift that exceeds the annual exclusion amount in any one calendar year to any one person, again, if he could give $18,000 to 50 people if he wanted to, but to the extent he gave more than $18,000 to one person, he needs to report that on the 709. No taxes due. And if you're concerned about audits or problems, there's not even, and because you said you, what did you say? You haven't gone over your lifetime exemption. The penalties for failing to file, and maybe there's penalties for incorrectly filing, but it looks like you gave it a shot. Even the penalties for failing to file, it's always a percentage of the tax owed. And typically with gift tax returns, there's no tax owed. You're just reporting that you made a gift in excess of the exclusion amount, which reduces the amount you can leave from your estate when you pass away. All right. So I think what you did are Wyatt 5292. is you gave me an idea of another live stream is to walk through the 709 and point some of that out. LJ says, Paul, can you advise why anyone would file a 706? You put 706B. I think you probably just meant 706. Even though they have not exceeded the lifetime exemptions ceiling, someone said it could still be advantageous to or just a waste of money. No, it is, and it's within the last decade or so, and with our new portability laws, it does make sense for the estates of people who have passed away who have less than the exemption amount to actually file an estate tax return in order to make that portability election. We'll touch on it briefly when I pop up the return, so that and again, this is if they're married, so that their surviving spouse gets to fully utilize the surviving spouse's exemption, but then the surviving spouse can also use the unused portion of the first spouse to die's exemption or exclusion amount. So we'll talk about that a little bit more when we get to portability. Yep, some people could perceive it as a waste of money, but the problem is when the first spouse dies, we don't know two things. Well, we don't know a lot of things, but two things we don't know when the first spouse dies is how large will the surviving spouse's estate be when the surviving spouse dies, and we don't know what will be the estate tax exemption that the surviving spouse has when the surviving spouse dies. Probably some surviving spouses survive for 10, 20, 30 years after their spouse dies. And so because of that uncertainty and because of, so many unknowns, it does make sense in many cases to file the estate tax return within 9 months after the first spouse dies, even though there's not a requirement that the return be filed. Okay, so that's a mouthful. What I want to do is I want to jump into the return here, and let's see here, get my little controls here, pop it up on the screen. Here we go. Voila. There is our United States estate and generation skipping transfer tax return. Okay, so let me get back to where I need to be. Good. Okay. So here it is, page 1. First, let's talk about who must file this return. It gets filed when someone passes away, and let's say their gross estate. Gross estate is everything they own before you deduct the deductions for debts and bequests to a spouse and charitable deductions and other administrative expenses. But their gross estate plus those taxable gifts that they had made during their lifetime. So I gave you the example where, dad gave $118,000. He made a $100,000 taxable gift. So if someone's gross estate plus their taxable gifts exceeds $13.61 million and they died in 2024, then there's a requirement that this estate tax return be filed. Also, it's required to be filed when a person's executor elects to transfer this or make that portability election, to transfer the deceased spousal unused exclusion called DSUE, DSUE, deceased spousal unused exclusion. Hey, mumbo jumbo words, but it's required to make that portability for that unused exclusion amount spouse. All right, so that's who needs to file it. Next is when to file it. Well, it needs to be filed within 9 months after the date of the decedent's death. Some people think it needs to be filed, by April 15th, kind of like the income tax return. The income tax return filing requirement has nothing to do with the estate tax return filing requirement. Do within 9 months after the date of the decedent's death. A little cute fact here. If you're going to be sending in tax, maybe your spouse, your parent, you're an executor, you're having to go through this, get this thing prepared, and send the return along with tax to the IRS. Little quirky note here. The IRS will not accept checks for $100 million or more. If you're handling one of these estate tax returns and somebody owes 150, or somebody's estate owes $150 million of estate tax, IRS says you're going to have to spread that payment over 2 or more checks. So that's my one little cute statement I'll make for today. All right, let's go through this. And and again, I'm going to go kind of fast, but the first stuff is pretty basic. All of this part two tax computation, it's you have to get a lot of figures from schedules that are later on in the return. You'll see up here, it's a 29-page document. So you have to get a lot of the summary figures from later in the return to make the tax computation. All right, so we may come back to that. Signatures are here on page 1, kind of like on your income tax return, signatures on page 1. All right, let's move into this part 3, elections by the executor. All right, one thing I want to go over is the alternate valuation. That's this question number 1 in part 3. A lot of people get that confused. A lot of people think that, that it's really easy and an alternate valuation should be elected often. The idea behind the alternate valuation election is if somebody dies with a $50 million estate on January 10th, and on February 10th, before anything gets reported, the stock market crashes and they lose 50% of the value of what was there on the date of death. So then that's when this alternate valuation comes into play. But it's kind of an all or nothing thing. And when I say all or nothing, I mean can't be the alternate valuation election can't be applied to only part of the property. And the idea behind the alternate valuation is instead of using the date of death valuation, which is the general rule, you can use the date 6 months after the date of death. So that takes into account estates that significantly were reduced in value after death. But you can only use this alternate valuation date if it decreases both the value of the gross estate and the sum reduced by allowable credits of the estate and generation skipping transfer taxes payable by reason of the decedent's death for the property included in the decedent's gross estate. So it's got to reduce the tax. A lot of estate tax returns are filed, especially for a married couple when the first spouse dies, because of the marital deduction. A lot of estate tax returns are filed when that married person dies because there was a requirement to file, but zero tax is due. Well, to use the alternate valuation date, it has to reduce the amount of tax that is owed. So anyway, just a little niche rule there. And then there's rules on how do you elect alternate valuation if an estate asset was sold during the 6-month period. So there's thoughts on that. Going down to number 3 here, the 6166 election. So if the gross estate includes an interest in a closely held business, you may be able to elect to pay part of the estate tax in installments under the 6166 election. The idea is you have a $50 million estate, and $40 million of it is a closely held business that the decedent owned that is not liquid. It's not easy to sell or create liquidity from that business that has a value of $40 million. Well, what the IRS says is if you meet the requirements, you can pay that tax over time, presumably out of the profits of the business, so that it doesn't require that quick sale of the business at less than fair market value. So we got that going on. All right, let's move on to part 4, general information. Let's see here. Let's move on. This one kind of catches everybody, especially the kind of preparers. They're like, oh, geez, what do I do here? And so this section here, it has nothing to do with the amount of tax owed. And it always kind of frustrates me when I have to go back and make all of these calculations. So this line 5 says you have to identify on the return everybody who is inheriting more than $5,000. You have to give the IRS information about them, and you have to report how much those individuals are inheriting. So I guess, that question is there because the IRS wants to know, hey, who's inheriting? So even though an inheritance may not be subject to income tax, it is if you inherit an IRA, a traditional IRA. But in fact, I did a big live stream about the tax consequences of inheriting yesterday. So anyway, it's just the IRS, I guess, wants to know who's inheriting from you so that maybe the IRS can check up on those people later. All right, so those are some kind of basics of the general information. And here, these are some recapitulation or what I call recaps of the value based on some schedules that are later on. So, and well, before we get to some of those schedules, let's talk about the portability election. So here it is here. This is where, again, if that married person dies and they have an $8 million estate, they died in 2024, they had an $8 million estate. Their estate tax exclusion amount was $13.61 million. They didn't use $5.61 million of their exclusion amount. This is where they can report, their estate can report, and then their surviving spouse gets their own exemption, plus the surviving spouse gets to utilize that $5.61 million of the first spouse to die's exclusion amount that wasn't used. So it's a great benefit. And that's where sometimes, even though an estate tax return is not required to be filed, it makes it advantageous because it can help reduce or, in many cases, eliminate estate tax when the surviving spouse later passes away. All right, so let's keep going here. Here's some of our schedules. Here's the schedule for real estate. You've got to describe the real estate in enough detail so that the IRS can easily locate it for inspection and for valuation. You've got to explain how the reported values were determined, and you need to attach copies of appraisals. So, if a person owns a lot of real estate, there's going to be appraisals. And by the time you ship all of this off to the IRS, you're going to need maybe a box to ship it in. So real important to get appraisals because you really want to thoroughly document the value of those pieces of real estate and which the kind of general rule is, don't hold me to this, but kind of the thicker the appraisal, the less likely it is that the IRS will question the value put on it. So those appraisals become real important for purposes of valuing real estate because, reasonable minds can differ on how real estate should be valued. So that's your real estate stuff. Let's keep going here. Next schedule is I want to go through is the stocks and bonds. So most people who pass away, they own some stocks and bonds. So for stocks, you've got to indicate a bunch of information. You've got to indicate things like the issue, the par value where needed for identification, the price per share, the exact name of the corporation. You've got to show the principal exchange upon which it's sold, if it's listed on an exchange, the 9-digit CUSIP number. And so you might wonder, how does the value of the stock get listed on the estate tax return? So the fair market value of stock or bond is that mean between the highest and lowest selling prices quoted on the valuation date. So again, John Doe died on July 15th, 2014. You go back and look at all of the stocks and bonds that he owned, and you have to report that fair market value, which is the mean between the highest and lowest selling prices on the valuation date, which let's say was July 15th or whatever date I said it was. All right, next is pretty self-explanatory: mortgages, notes, and cash. Mortgages doesn't mean mortgages you owe. Mortgages means you own the mortgage and someone is paying you. So that's an asset of yours that needs to be reported on this Schedule C. Same thing with promissory notes. Again, not a note that where you owe someone else. It's you own the note and someone is paying you on that note. Again, that another asset that has value. Cash includes, obviously, if you have, $100,000 in cash, that needs to be all the various bank accounts that you may have. So that's the mortgages, notes, and cash. Let's keep going here. Schedule D, insurance on the decedent's life. Again, a lot of people initially, but I thought life insurance was tax-free. And so now whenever somebody says that to me, I kind of get the feeling that they're confusing the income tax consequences of being a beneficiary of a life insurance policy versus the estate tax consequences of owning a life insurance policy and being the insured. So when people say, but why is there this schedule on the estate tax return for life insurance? Because life insurance is tax free. Well, yes, that's an income tax rule, but a very different rule for estate tax. The main thing about life insurance on the estate tax is, um, especially for insurance receivable by beneficiaries other than the estate, you have to include on this Schedule D the proceeds, those proceeds that are paid out of all the insurance on the life of the deceased or the decedent. Um, and if the decedent possessed at death any of what's called the incidents of ownership. An incident of ownership is the right to change the beneficiary, the right to access the cash value. There's a whole list of incidents of ownership. So very typical scenario, dad, when he was alive, he bought some life insurance, maybe for his spouse to be the beneficiary of. Maybe he didn't have a spouse, and maybe he did have a spouse, but nonetheless, maybe he named his children or others as beneficiaries. And let's say he had $3 million of life insurance. But all life insurance policies have an owner, have an insured, and have one or more beneficiaries. So if dad bought that life insurance, unless he really did it in an attempt to keep that out of his estate, dad was probably the owner of that life insurance policy. And dad, because dad is also the insured. Insured means when the insured dies, that's when the life insurance pays out the death benefit. So dad is the insured. And the beneficiaries could be wife, could be kids, could be anybody. So that's a case where if when dad dies, he had incidents of ownership, and this life insurance gets included in his gross estate. Now, I will tell you, if he did have a spouse and he named his spouse as the beneficiary, then that death benefit will be deducted from his estate because it qualifies for the marital deduction because he left it to a spouse. More on that later. But yeah, if dad owned any incident of ownership, it's included on Schedule D. Now, for people who do have life insurance and they kind of get active and knowledgeable about how to avoid estate tax, oftentimes they will, the children will purchase life insurance on the father, and the father will make gifts to the children so that the children can pay for the policy, or it's done through what is commonly referred to as an ILIT, irrevocable life insurance trust. And now the children or the trust own the policy, and dad doesn't have any incidents of ownership. So even though dad is the insured, he's not the owner, doesn't have any incidents of ownership. Children or the trust is the or are the beneficiaries. That's one way to keep those death benefits out of the estate. If that was the case, that those life insurance proceeds would not be reported on Schedule D here and subject to estate tax. All right, so that's enough there on life insurance. We have a jointly owned property. I'm not going to get too much into that. That's if you own property with another. I got some going. So then Schedule F, let's look at that. That's the other miscellaneous property, not reportable under any other schedule. A lot of things get reported on here. Things like debts that were due to the decedent. Sometimes people own life insurance on the life of another, and those policies have value. Maybe they have cash value. And so here is where those policies would be included on Schedule F. Claims, including the value of the decedent's interest in a claim for refund of income taxes. Again, that's just another miscellaneous thing. Digital assets, if they have value, they're listed here. Royalties, leaseholds, judgments. So lots and lots, farm products and growing crops, livestock, farm machinery, automobiles, they all get listed on Schedule F. Been asked a lot of times over the years, Paul, if we got a bunch of like art on the wall or a bunch of, some antiques, do we really, or if our dad had that, do we have to report that on dad's estate tax return? So here's your answer there. Did the decedent, let's see if I can get it all. Did the decedent own any works of art, items, or any collections whose artistic or collectible value at date of death exceed $3,000? If yes, submit full details on this schedule and attach appraisal. There's your answer. All right, so we've got that going on. Another, sometimes you see those gonna beat the IRS people who will say, you know what, I'm gonna stuff a bunch of cash and expensive jewelry in my safe deposit box. I'll fool the IRS. Those words didn't come from me. Question on the estate tax return. Dad died. He's got a safe deposit box full of stuff. Did the decedent at the time of death have access to a safe deposit box? If yes, state location and then blah, blah, blah. Any of the contents are omitted, explain why. So there you go. All right, so they want to know all about that. Okay, so we're rolling right along here. It looks like Susie, hey, yeah, greetings to you as well. Michael, maybe too arcane for the show, how the executor of a trust settlor uses to claim the settlor's. Yeah, I'm trying, good question, Michael, but I'm trying to stay away from the generation skipping transfer tax for purposes of this introduction to the 706. Yes, we do have a generation skipping transfer tax. In fact, it's in the title of the form. And it's an extra tax that applies when, generally speaking, it's very complicated, but you leave assets to people 2 or more generations younger than you. The main idea there is the IRS would like to collect estate tax when you pass away. And then after the estate taxes are calculated, your children inherit. And then the IRS would like to collect more estate tax when your children pass away and leave those assets to your grandchildren. So they penalize you by leaving too much or too many assets directly to your grandchildren or to what is called skip persons. So I'm not gonna dive into the generation skipping transfer tax, Michael. Good question. That's an appropriate question for a different live stream. All right, so let's keep going here. We've got some good stuff. We've got let's see, I'm blowing through some of this stuff. I'm going to skip that one. Annuities, I'm trying to use the stuff that applies most of the time. Annuities you might be thinking, I don't have any annuities or dad didn't have any annuities, but oftentimes, most of the time, there are assets reported on this Schedule I. IRAs, for some reason, are supposed to be reported on Schedule I. So an IRA technically is not an annuity. An IRA typically, it's an account. But the IRA assets go on Schedule I. Let's keep going. Funeral expenses, and let me check something here real quick. Good. Funeral expenses. So this is where, if Jack died and he had a $15 million estate, but he had a phenomenal funeral that cost $300,000. And his executor was entitled to 2 or 3% of the estate. And there were significant attorney's fees and accounting fees and other miscellaneous expenses. All that gets reported here on this Schedule J, because let me change the numbers a little bit. If he died this year, $13.61 million exemption. Dad died with a $14 million gross estate, but $500,000 of Schedule J that would reduce dad's net estate from 14 million to 13.5. Under the $13.61 million exclusion amount, 0 tax would be due. So you want to take advantage of all these deductions. Debts of the decedent, yeah, if in addition to his Schedule J expenses, if he had a $1 million mortgage or other debts, he had a $15 million estate, but he had a $4 million house and he still owed $1 million on it. That $1 million gets listed here and gets deducted from his gross estate before the net estate is calculated. Keep going here. Not going to talk too much about that. Big one here, Schedule M, bequests to surviving spouse. So this applies when a married person dies. And you use this schedule to take advantage of the marital deduction. All right. Quick introductory overview of the marital deduction. Let's say dad died. Dad was married to mom. Dad himself had a $15 million estate. Of course, mom had some assets of her own, but dad died with $15 million. And its most simplest form, let's say dad left $5 million to mom. He had a gross estate of $15 million. He left $5 million to mom, whether that was his IRA, or whether it was life insurance where mom was the beneficiary, or it was a bequest in his will or his living trust that went to mom. Well, that bequest to his surviving spouse qualifies to be reported on Schedule M as a marital deduction item. So if it's just that, gross estate $15 million, left $5 million to his surviving spouse, those assets that get left to the surviving spouse are reported on Schedule M. Dad's net estate is $10 million. Under the 13.61 million, there's no tax due. Potentially, though, that $5 million now gets added to mom's estate, and potentially there could be estate tax due when mom later dies, depending upon mom's assets, how much she inherited, her exemption when she dies, and whether a portability election was made on dad's estate tax return. You're also going to hear a lot, if you hang in estate planning circles for a while, you'll hear a lot about Q-tip property. So let's talk about that for a minute. What I talked about just now was dad just he left things to mom. I call it outright. Named her as the beneficiary in his will or trust. I leave my business to mom. I leave my stock portfolio to mom. And that those assets become mom's to do whatever she wants to do with them, including leaving them to her children, their children, the pool boy, the next spouse, whatever. Some dads out there are a little leery about that. And leery is not the right word, but they want that peace of mind to know that they want to provide for their spouse, but they want to know that when their spouse later dies, those assets won't be left to the next spouse. They'll go on perhaps to the children of dad. So that's where assets left in a commonly referred to as Q-tip trust also qualify for the marital deduction if the proper election is made. Outright bequests to a spouse automatically qualify for the marital deduction. Assets left to a Q-tip trust qualify for the marital deduction, but an election must be made to qualify them for the marital deduction. So what is a Q-tip trust, or what does Q-tip mean? Q-tip stands for, I hate to even use the words because it's word salad, as they say, qualified terminable interest property. So Q-tip property is property that passes from the decedent in which the surviving spouse has what's called a qualifying income interest for life, and estate tax return has been made. So common scenario, dad has $15 million. He wants to make sure dad has $20 million estate, which is well over $13.61 million. He doesn't want there to be estate tax due when he dies. He wants to take advantage of deductions that are available. He wants to take advantage of the marital deduction. He's a little uncomfortable leaving $10 million to mom because he fears that it may not wind up in his children's hands when his surviving wife later dies. So instead of just leaving assets to his wife, he leaves them to a Q-tip trust, a trust in which his surviving wife has a qualifying income interest for life. She gets the income from those trust assets for the rest of her lifetime. That has to be in there in order to qualify for Q-tip treatment. So, in fact, this income interest for life, the surviving spouse has a qualifying income interest for life if the surviving spouse is entitled to all of the income from the property payable annually or at more frequent intervals than annually, or for you Louisiana folks, where we have a usufruct form of ownership. This Q-tip is also met if the decedent left a usufruct interest for life in the property to their spouse. And then there's a couple of other requirements during the surviving spouse's lifetime. No person has a power to appoint any part of the property to any person other than the surviving spouse. What the IRS wants to make sure is those assets are there when the surviving spouse dies, so the IRS can collect the estate tax on those assets when the surviving spouse dies. So that's where all of this gets reported on this Schedule M. Good stuff here on a really important schedule on the estate tax return. In addition to the marital deduction, there's also, let's call it the charitable deduction. Some people, they want to leave a portion of their estate to their favorite charity or charities, their churches, the universities. The government wants to encourage people to leave assets to charity because charities are supposed to be doing the work that the government would have to do if the charities weren't around to do it. So again, dad has a $30 million estate. He leaves $20 million to various charities. That all those charitable bequests would be reported on Schedule O. That's a deduction from the estate. Gross estate 30 million, charitable deduction 20 million, net estate 10 million, under 13.61 million, no tax. All right, then other things. Here's our generation skipping transfer tax, which I'm not going to get into, but Michael asked a question about it. More on that there. And really that, about wraps up the main things that we see. And then once you complete all of those various schedules, you have to go back and report the totals on those different schedules, really on page 1, the total of the assets from the various schedules, the total of the debts from the various schedules, the portability election, and the calculation of the tax gets made. So all that goes back here on Schedule 1. All right, so that should give you at least an introduction of what's going on and how does the estate actually report and wind up paying tax. First, how do the assets get reported when someone dies, and then if there is tax due, how does that tax get calculated? So hope that helps. That was a